What up, though? Welcome to another episode of Mansa Trading, and today we're gonna talk about what is a pip, right? You need to know all these terminologies and everything to be able to properly trade forex. So, pip is very important. So we're gonna dive right into what is a pip. Okay, pip stands for percentage in point. It is the price interest point. Pip is a unit of measurement for price movements of currencies and foreign exchange FX markets. Pip stands for percentage in point or price interest points. It represents the smallest price variations that a particular exchange rate experiences based on typical FX market convention. A measure a change in value in a currency pair. So that's what a pip is. So let's go ahead and look at this example because examples make everything easier. It explains everything way much better, and that's why it's called an example. So, if we're looking at at this one, we got the Euro USD. So, for example, let's say the Euro USD moves from 1.4700 to 1.4705, right? And when you're looking at pips, most of the time you're looking at the numbers after the decimal. So you're looking at the 4700 and then you're looking at the 4705, right? So you're looking at the numbers after the decimal. So if we went from 1.4700 to 1.4705, how many pips is that, right? That is an increase of 5 pips. So the market went up 5 pips. And like I said, when you're looking at pips, you're usually looking for the number the fourth decimal most of the time, but that's not in all cases. But for a lot of major pairs, you're looking at the fourth decimal. So that was an increase of 5 pips. So let's go ahead and look at example number 2. And example number 2 is Euro USD moves from 1.3400 to 1.3350. So how many pips is that? That is a decrease of 50 pips, right? Because once again, like I said, you're usually looking for the numbers after the decimal. So that was 3,400 to 3,350. So that was a decrease of 50 pips. Now let's go ahead to example number 3. And I want to do these examples because I want to show you, the difference in pips in different pairs, currency pairs. Because last 2 examples we did Euro USD. Now let's move on to USD JPY. And if you look, let's say USD JPY moves from 132.580 to 132.120. So how many pips is that, right? That is a decrease of 460 pips, right? Because mind you, once again, we're usually looking at the numbers after the decimal. So if you do 580 minus 120, that'll be 460 pips. Now, next video, I'm going to get into leverages and lot sizes, and how to do that through your broker, because that's the next piece of the puzzle that makes this make all sense, right? But, for right now, when you buy U.S. dollars with Japanese yen, you are in fact buying shares of the U.S. economy. So that means you are expecting the U.S. economy to outperform the Japanese economy. And then when you sell USD JPY, you are buying yen and you are selling US dollars, and you are expecting the value of the US dollar to go down and the value of the yen to rise. So you can make money if the US currency goes up compared to the yen, or you can make money if the US currency goes down compared to the yen. So you can make money both ways. And with that being said, let me go ahead and give you another example so it can make more sense to you. So this is example number 4. So let's say USD JPY goes from 132.580 to 132.980. So how many pips is that, right? So that is a 400 pip increase. That's a 400 pip increase. And then how you make money, so when you download MT4 and you enter the market, let's say you enter the market at 0.25, right? So you enter the market at 0.25 on the buy, which is equivalent to 25 cents for each pip. So for every 1 pip that it moves, you will make 25 cents. So let's say you want to do $1. So every pip that it moves, you will make $1. Or let's say $2. For every pip it moves, you will make $2. But as of right now, for example's sake, let's stick to 25 cents. So how much money did you make if it went from 132.580 to 132.980, which is 400 pip increase, and you entered at 25 cents a pip? So that means you made $100 off of that whole transaction. And let's say you got out at 980, so you made $100. Now, the opposite is true as well. If you entered at 0.25 on the sale, you would have lost $100. So let's say you thought that the market was gonna go up, and you decided to buy, and you entered in at 25 cents, and it did the complete opposite. You would have lost $100. And then that leads me to my last example number 5. So once again, like I said, USD JPY, you would have lost that money, right? But let's say you were predicting the sell and you were correct, and it went from 132.580 to 132.180. So how many pips is that? That's a 400 pip decrease. And remind you, you decided to sell this pair instead of buy it. So at this point, you are in the right direction based off of selling. So you enter the market on a sale at 25 cents. You would have made $100 from selling and predicting the market correctly. And that is why forex is so great, because you could either buy or sell any currency pair, metals, or crypto. So if the economy of whichever country is doing good, you can make the money. If the economy is crashing, hey, you could still make money. You can always win no matter what. That's why they give you the option to buy or sell, right? And then remind you, you're not going to always be correct. So sometimes you will lose money, sometimes you will win money. Now, your winning level will be based on your market strategy and how you trade forex, which I will get into later in my videos, explaining exactly how I break down the charts and how I trade. But as of right now, we're talking about pips, so I want to give you guys a clear indication of how pips are measured and how they move. So, if we did a quick recap, pip stands for percentage and point, right? It is a measure of change in value in currency pair. That's all a pip is. That's all they're doing is measuring the value change in currency pairs so you can come in and make your money.